Before the break, we went through a lot of revision in terms of the actual adjustments. There are a few things here that we need to look at purely because they're important for disclosure in this module. So when you looked at 1502, you covered a topic called non-current assets, and you covered other, and you covered financial. So there were two types of non-current assets. We need to revisit that because if you recall, 1502 didn't examine that. So they never ever gave you something like an intangible, or they never gave you a financial instrument or a cash investment or investments in shares. Here in this module, you'll see quite a lot of those examples where they actually give you a non-current financial asset that you need to disclose. So the first thing that we need to revise is obviously the timing. So when is something considered non-current?
When it's long-term, over 12 months.
Exactly. So that's the important bit. So if I have a scenario where I have an amount that's greater than 12 months, it meets the definition of a non-current asset. But at the same time, I can have a portion of it being short-term. So here's an example. Let's talk about investment in shares. Okay, let's say we've got January and we've got December and then we've got the new year. So that's the 12 months, okay, of last year. So that's last year's 12 months. Then we've got this year's 12 months, okay, and then we'll have another 12 months later on. Okay, so there are 3 years there. Okay, so if I'm looking at the current year, that's the current year. Do you agree?
Yes.
Okay, so is last year important for this year?
No.
No, last year isn't important for this year. Okay, so if I'm focusing on this year, I'm going to have to disclose everything for that current financial year. But if it's greater than 12 months, it's long term. If it's less than 12 months, it's short term. So let's say I have a scenario where a portion of the investment is going to be cashed in, okay, or it's going to mature. So let's say 6 months down the line, okay, there's going to be a payout. And then 18 months down the line, so a further 12 months, there's going to be another payout. And then that's going to end the investment. So if I'm looking at short term and long term, what is short term and what is long term?
Won't the maturing be short term?
Which one?
The second one.
Okay, yes. This would be greater than 12 months.
Yeah.
Okay, which is long term. Great. Because it's greater than 12 months. What happens to this?
It's going to be short term.
Correct. What do we call short term assets?
Yeah.
What do we call short term assets?
Current.
Correct. Current assets. Okay, so in this module, when we look at examples, you'll see things like that, where you'll see, I'm just talking about an asset here. It could apply to a loan as well. So if I just write down the word loan, we know you get long-term loans and you get short-term loans.
Yeah.
But one loan could have a long-term portion and a short-term portion. So the disclosure is a bit more detailed because you're taking one account and then you're disclosing it twice. You're showing part of it as short-term and part of it as long-term. All right, does that make sense?
Yes.
Okay, so what is the accounting effect on the different accounts?
I don't know.
What are all these accounts?
Assets.
Exactly. So that's not going to change. The accounting effect will be a debit plus and a credit minus because it meets the definition. So an intangible, a financial instrument, a cash investment, an investment in shares, all of it still represents the asset in terms of being in terms of meeting the definition of being an asset because it's a resource controlled by the entity that arises from a past event.
Yeah.
Make sense?
Yes, it does.
Good. Okay, then we've got a note about tangibles and intangibles. Tangible assets, we have property, plant, and equipment. Okay, they're tangible. Tangible meaning They're fixed.
You
They're
can touch.
physical assets. Okay.
Yeah.
Intangible means they're not fixed or physical assets. They're things like goodwill, development.
And you cannot see them.
Yes, things that you can't see, things that you can't touch, those are intangible. Okay, brands, copyright, franchises, licenses, models, patents, prototypes. There's such a lot. Websites, trademarks. But do those have value?
Yes.
Yes, they do. So goodwill is value, a patent is value, a prototype, a brand. Those are all things that have value, but they're not physical assets like PPE. So do we still have to account for them then?
Yes.
Of course we do. Okay, and in this module, the important one is this one, goodwill. Okay, NB. Okay, it's the first time you'll see goodwill in your accounting studies. Okay, goodwill is covered under the partnership section. We talk about partners having goodwill in a particular business. All right, we'll discuss the calculation of goodwill and what it actually means. For now, all we need to know is what type of account is goodwill?
Intangible asset. Yeah.
It's an asset, yeah. Okay, don't worry too much about whether it's tangible, intangible. That's not so important because that's just the physical practicality of the actual item. So goodwill we know is intangible, property, plant, and equipment we know is tangible. But goodwill, all that's important for us is what is the element. The element is an asset.
Yes.
Okay. Financial instruments, you get different types. So you get assets and you get liabilities. Alright, so now we're expanding a little bit because we can also apply our theory that relates to liability to these types of accounts. Remember, they're just names for different accounts. So for example, I can talk about equity. If I talk about equity, what type of account would that be? An asset or liability?
Asset.
It'll be an asset because if you hold equity, okay, remember we're looking at it as a financial asset, as an investment, as something that I'm holding for either long term or short term.
Yeah.
Okay, and that's why equity. It's not the equity that we spoke about in terms of owner's equity. Owner's equity is very different to equity here because the equity we have here is the investment that we hold in shares, for example.
Yeah.
Okay, that would be an asset. Right, then if I talk about something like a debenture, what type of instrument is the debenture? Asset, liability?
It's a liability.
Yes, okay, it would be a liability because it's a loan type of instrument.
Isn't it when the government loan money from you or you loan money from the government?
Okay, it does depend on if it's a loan to or loan from. Okay, so that's a good point in terms of it doesn't matter who you loan the money from. It can be from government, it can be from private individuals, it can be from companies. There can be loans to and there can be loans from. So if I talk about a loan to, so if let's say the business that we are accounting for, the business gives a loan to someone, what would that be, an asset or liability?
A business gives a loan to someone, it's an asset.
Good, why?
Because it's a resource and you're not obligated to pay.
Correct. You don't have the obligation to pay. The person you've given the loan has the obligation to pay.
Yeah.
Right, so because you've given someone a loan to, so giving loans to someone is viewed as a asset.
Yeah.
Okay, getting loans from someone. So if you take a loan from me, do you have an asset or do you have a liability?
It's liability.
Exactly. Okay, you will have a liability because you've taken a loan from someone. Make sense?
Yes, it does.
Perfect. Okay, so remember that because we'll cover that in more detail again later. All of these are basics. You'll see all of this come up again and again and again. So hopefully by the end of the 12 weeks heading into your exam, all of this should be quite, you should be quite comfortable with it and you should be okay for the actual assessment. Okay. All right, there's just one other note here. Disclosure. We know disclosure is NB. Why?
Because I always test it. I don't.
Correct. They always test it, and it's the focus in terms of the users. Users want information, and that information needs to be expressed correctly, represented correctly. The layout needs to be correct. The format. Okay, all of that is disclosure. So when looking at strict disclosure, you do need to focus on how do they want you to represent the information. And remember, the textbook gives you slightly more detailed disclosure. Okay, you need to try stick to the UNISA way of disclosing information. And that's why the examples they give you in the study guide are key, because you can actually see how they're answering their own questions. So that's the way that we'll treat it in terms of the layout and format. Okay, the textbook is actually very, very good, or a lot better than obviously the UNISA material, but the textbook and the study guide work hand in hand. I would stick more to the study guide for practice, because those examples will be very similar to what the actual UNISA examiner would use as their solution, okay, for their memo.
Yeah.
Right, then we spoke about value. Okay, we touched on value previously on Monday when we spoke about things like carrying value, we spoke about cost, we spoke about the measuring of financial assets and liabilities in terms of the how do we measure it, okay, if you can remember that. So here we've got market value and fair value. What is that? What is market value? What is fair value? What does that mean?
Market value is the price that all the companies are selling it at.
Good. Okay, so it's market meaning a willing buyer and a willing seller. So in the market, what are people willing to pay for those assets or liabilities, depending on what type of product you're selling? Okay. All right, just a bit of accounts. So now we've got some debits and credits here. The first bit is the investment. Okay, in a fixed deposit, we've got a debit for it because we're recording the initial investment. So if I record an initial investment, what's happening to that account? Is it going up or down?
It's going up.
It's going up. What type of account is an investment?
An asset.
An asset. So where do assets go up?
On the debit side.
Correct. And that's how we get the debit investment. I've just put the word investment. It could be anything. I've just put one example here, fixed deposit. There could be a investment in shares, investment in debentures, bonds, whatever. It could be anything really. Okay, and then the credit. Why do I credit the bank?
Because it's decreasing.
Exactly. I'm using cash to invest. Good. Now we look at the returns. Investments generate a return. So there are two ways that you can treat the return. You can either capitalize the return, or you can get paid the return out in cash. Right, so capitalizing returns means I'm adding to the value of the asset. So how do I increase the value of an asset?
You invest.
You debit it. Okay, remember you're investing in an asset. And that asset value will grow, hopefully, over time.
Yeah. So
if that's the case, capitalizing a return means I'm going to increase the value of the investment.
Yeah.
Okay, so again, I'm using the example here of a fixed deposit. A fixed deposit pays interest. Is the interest an asset?
No.
No. The interest is an inflow of economic benefit. So what definition does that meet?
It's an income.
Exactly. And that's why you've got those two accounts.
Yeah.
Debit the asset to increase it, credit the income to increase it. And we're debiting the actual fixed deposit in this example because we're capitalizing the returns.
Yeah.
Let's say you're not wanting to capitalize the returns. I'm not going to do this. I'm going to do this. I'm going to get the returns paid out. Okay, so if I pay out the returns, the bank's going to go up because I'm receiving the cash. And we know if I receive cash, what happens to the bank?
It's going to increase.
Exactly. It goes up and income will go up because I'm getting benefit. I'm earning something.
Yeah.
Happy with those two?
Yes, I am.
Okay, good. All right, so I want you to try to do the same thing with this one. Okay, in terms of the whys. What can you do here in terms of explaining the whys? Maybe let's start with the first one. Okay, try to answer that question and then think about this, transaction costs, and then we'll discuss it. I'll give you guys a few minutes just to get the answer there, just for the first one, and then let's check that one, and then we'll discuss the one at the bottom, okay?
Okay.
Because technically you'd be getting money into your you'd be making money
For the company, yeah.
Okay, so if I look at the first bit, it says we're recording the initial investments. Okay,
Yeah.
so if we're recording the initial investments, what's actually happening?
So it's made money.
We're investing.
Yeah.
Does that make sense?
Yeah.
So
Yeah.
if we're investing in shares or equity, are we going to increase the actual investment?
No.
We will, because we're investing in that particular asset.
Okay.
Does that make sense?
Yes, it does.
Okay, so if I'm investing in that particular asset, the asset is going to go up or down?
Up.
Correct, it's going to increase. So that's why I debit the investment in company X.
Okay.
And what am I going to use to invest? I need to take cash from somewhere to invest, right?
An expense.
No, it won't be an expense, it'll be bank.
Okay. Okay.
Okay, because I'm taking cash and I'm investing it into equity.
Okay, so they're both assets.
They're both assets, yes. Okay, the one is decreasing, the one is increasing.
Okay.
Okay, does that make sense?
Yes, it does.
Alright, so I'm taking cash from the bank and I'm investing it into equity. I'm investing it into shares. Investment in company X.
Yeah.
Okay, yeah.
Right,
Makes
so
sense.
what would happen if there are transaction costs?
It's going to increase the amount.
No, there's a clue there. It's a separate account. So what
So
account will I have?
Bank.
Okay, if I pay the transaction cost, I will affect the bank, and what else?
Liability.
No liability here. There's no obligation.
Expense.
Why?
Because it's something you've incurred.
Correct. It's a cost you've incurred, yes. So if I'm going to be paying transaction costs for investing, what's going to happen to my transaction costs?
They're going to increase.
Correct. I'm going to record more of them. So I'm going to record more transaction costs. So I'll debit what account?
Bank.
The expense.
Okay.
If I debit bank, bank goes up. Nothing's going up here.
Credit bank and debit expense, yeah.
Credit bank, debit expense. Yeah, let's give it a name. Let's call it transaction cost or share expenses.
Okay.
Share purchase expenses. It doesn't matter what we call it. You'll have to refer to the trial balance to identify what they're using. Okay, so share purchase expenses. Okay, and then credit bank.
Yeah.
Okay. Then we've got adjustments. So now, previously we spoke about capitalizing a return or getting the return paid out. Here we're focusing on the actual investment. So if I'm investing, is the investment going to fluctuate in terms of value? Possibly.
Yeah.
Okay, investments will change in terms of value and we'll have a market or fair value to gauge the actual value of that particular asset. Okay, or liability depending. So if I'm looking at this, debit the investment in company X, what happened to the value of the asset? Did it go up or down?
Increased.
Correct. So if it went up, I'm going to get a gain on the fair value adjustment. Fair value meaning what is the current market value for that particular asset? Right, so was the investment in company X worthwhile?
Yes, it was.
Yes, it was, because the investment has increased in value. So what happens to the investment account? It goes up. What type of element is that?
An asset.
Correct. So asset increase, income increase. Happy?
Yes.
Okay, so now try to do that for the last one. Give me the Y.
Okay, loss on fair value. The asset's going to decrease
Why?
because there was a loss on the investment, and asset decreases on the credit side.
Yes, okay, good. So the investment has decreased in terms of value, yes?
Yeah.
Great. So if I decrease the investment, I need to credit it.
Yeah.
And then I'm going to debit the
Income.
expense.
Okay.
Yeah, you can't debit income, we're debiting the expense. Because remember, it's a loss. A loss on fair value adjustment meets the definition of which account?
Of the expense.
Yes, of the expense, correct. Good. Happy?
Yes.
Yeah.
Alright, then just the last note here, I've given you a few general slides here in terms of the closing transfers. Again, something that you need to be mindful of, because we're not going to be looking at the closing transfers for a sole proprietor because the focus has changed. We're going to be looking at the closing transfers for partnerships, CCs, and companies. Okay,
Yeah.
so before we can do that, we need to understand this. Profit. What is profit?
It's owner's equity equals assets minus expenses minus income.
Other way
Income.
around. Income minus expenses.
Expenses, yeah.
Okay, profit is income minus expenses. And where do we calculate profit for a sole proprietor?
On the statement of comprehensive income.
Okay, that's good. That's for disclosure. Okay,
Oh.
but in terms of accounts, the trading account calculates which profit? Gross profit.
Yeah.
And profit and loss? What profit?
Net.
Correct. Okay, good. So we're looking at a general ledger account. Those accounts will be grouped in a specific category, and that category will then be pulled through and disclosed onto the statements.
Yeah.
Yeah.
Gross profit is calculated in the trading account. Net profit is calculated in the profit and loss. Okay, remember that because we'll use similar words for the other types of businesses. They'll just change the vocabulary slightly, but they're still the same types of accounts in terms of their working.
Yeah.
Okay, do you remember the difference between periodic and perpetual?
Yeah.
Yes, a little bit.
Okay, tell me about perpetual.
Perpetual has to use a cost of sales.
Why?
Because it has to work out the individual items on the stock.
Correct, good. So you'll have a cost price plus markup.
Yeah.
What else? What types of businesses use a perpetual system?
Oh gosh.
Companies with lots of items?
No, not lots of items.
Yes, okay. Items that they can monitor and items that are normally quite expensive as well because you need to keep track of every single item all the time.
Yeah.
Great. Periodic? Kirsty, tell me about periodic.
A periodic has no cost of sales,
What else?
and it's collective.
Okay, meaning what type of businesses would use that system?
So companies that have a lot of stock,
Good. For example?
macro, pick and pay.
Good. Okay, big retailers are definitely going to be using a periodic system because for them it'll be nearly impossible to keep track of every item all the time.
Yeah.
Yeah.
Okay, good. Alright, so cost of sales is key. You are going to have to know how to work out cost of sales, and there's the revision note about it. Okay. Cost of sales is opening balance plus purchases minus returns plus other minus closing balance. Okay, you've seen that before. It's not new. It shouldn't be new. And we do that calculation in the trading account. Okay. The reason why I've put this slide up is because it focuses on the periodic system. Is UNISA ever going to tell you what system is being used?
No.
No, you'll just have to know.
Exactly. So how do we know which system is being used? We need to look at the words, the vocabulary used in the question.
Yeah.
Right, so as soon as I see the word purchases or purchases returns, I know I'm dealing with which system?
Perpetual.
No.
Periodic.
Yes, purchases and purchases returns relates to the periodic system.
Okay.
Okay, and what's special about the periodic system? You don't have cost of sales because you have to calculate it separately. And that's why the formula is important.
Okay.
Okay. The next bit over here is the stock take. Why are we going to take stock?
because you have to know how much inventory you have to sell.
Okay, you need to know how much inventory is available. That's the important bit. Okay, we need to know how much inventory is on hand, because remember, inventory on hand is called what?
Closing stock.
Good. And where do we disclose closing stock?
On the trade account?
No.
Oh.
What type of account is closing stock?
Periodic.
No, what type of account? Element. Give me the element.
Asset.
Good. So if it's an asset, where does it go?
On the debit side.
No, that's the rule for the asset. Where do assets get disclosed?
On the statement of financial position.
Good. That's the answer I'm looking for.
Oh, sorry.
Okay. So remember, we said this particular module is all about disclosure. So yes, you might know what the periodic system is. Yes, you might know what the stock take means. You might know how to calculate cost of sales. But that's all well and good. To get your marks in the exam, you need to know where to put all the information. Okay, so where do I put the closing stock? The closing stock goes to the statement of financial position. Where do I put the cost of sales?
Won't it? No. Isn't that going to be income?
Oh, well, no. Cost of sales is an expense.
So statement of comprehensive income.
Yes. Okay, statement of comprehensive income. 100%. Well done. Okay, that's great. Okay, so those are two accounts that need to be disclosed appropriately when dealing with the periodic system. The closing stock goes to the face of the statement of financial position, and the cost of sales goes to the statement of comprehensive income because it's an expense. Okay, so the one's an expense, the one's an asset.
Yeah.
Okay, I've just put a note here for the Y in terms of the actual selling of stock. Nothing changes there. That's basic. That's what you've always done with the bank and sales. So bank and sales, if your account is increasing, and debtors, okay, or sales, debtors and sales, or bank and sales, in terms of the debit and credit for that particular account.
Yeah.
Okay.
Perfect.
Everyone all right so far?
Yes.
Great. Okay, and then the last slide here is, do you remember some of these? Okay, I've given you a list here of different types of assets, liabilities, income, and expenses. Okay, so if you can remember back to 1502, we actually tried to build one of our own right at the beginning when accounting was still new. If we look at your accounting knowledge now, you should be able to put all of this into a table, okay? Because you've seen these accounts before and you've looked at the actual disclosure before. Some of the important ones, or the more important ones, I've tried to highlight in red. Okay, so debtors is important, prepaid, accrued, all those adjustments, those adjustments we started with today. Okay, they're important for this course as well. Depreciation is also a big one, that comes up quite often. Okay, then from time to time you do see some of the others, they do come up here and there. They're not as detailed. They tend to focus more on the ones that require more of a calculation. Okay, so debtors we know has a separate calculation because of the credit losses. The adjustments we know has a calculation because you need to look at timing. Okay, you need to look at the 12 months. Depreciation we know has a calculation because you've either got straight line or diminishing balance.
Yeah.
Okay, and then obviously the ones that we've looked at in this set of slides, okay, which are these ones, the ones in bold, okay, loss on fair value adjustment, PPE we spoke about, and then the financial instruments. Okay, that's also quite a big focus in terms of exams. Not as much as the others, but you do tend to see those a bit more than some of the other points. Okay, the other points I'm hoping are still okay in terms of your background knowledge and information. This one we'll discuss next time when we start partnerships. Okay, so we'll cover the theory with partnerships then. Now I'm going to go over through to your study guide, okay, and your textbook. Okay, I'm going to refer to an example in your study guide. So this week was all assumed knowledge. Okay, that was the focus for this particular week, trying to get you guys all, let's say, trying to keep the information that you've studied previously fresh. Okay, so refreshing what you've already covered previously, and then building on that as we go forward. Okay, so that's the end of the slides. Okay. Alright, so I want you guys to have a look at your study guide. Eunice would have sent that through to you. Okay, you would have seen that study unit 1 is the introduction to the preparation of financial statements. Okay, they've given you 13 pages in your study guide that covers all of what we've looked at this week. Okay, so we've looked at the conceptual framework, we've looked at the IFRS, we know presentation and disclosure is important, and we obviously need to know more about the financial instruments because that's a focal point in their questions that they'll ask you. Alright, so I just want to go through the example here in the exercise. Okay, all of this we've looked at, they give you some recap, and they also refer you to certain paragraphs in the prescribed textbook. The textbook that you have for volume 2 for this course does give you some background information, but as I said, unfortunately all the rules, the actual examples and rules are covered in the first textbook, volume 1. Okay, so both are important to do well in this particular module. Okay, so there's it there. Okay, here's the exercise and solution. Okay, so they do give you solutions to this. I just want to quickly run through these questions, and then I'm going to focus on this last one because there's an accounting question there. Okay, on 1st March, Lewis CC purchased ordinary shares. So we'll discuss that one together. Let's quickly test you guys in terms of your understanding so far. A bit of revision from Monday as well. Okay, so let's start with question A. Let's ask Kirsty. Kirsty, main users of the financial statements?
Businesses and companies.
Great, businesses and companies. So if we had to group those, we could group them into internal and
External.
external. Yes. Okay, we'll group those two together. Okay. Specific purposes of the conceptual framework. Brogan, why do we need it?
To know the day-to-day business and to understand what's going on within the finance of the company.
Okay, that's good in terms of the purpose, but if we're looking specifically at the conceptual framework, what is the conceptual framework? Give me another name for it.
Accounting, statements.
Okay, rule book, rules. Okay, rules, that's the key thing. Okay, so the conceptual framework is basically the outline of the rules. Okay, in accordance with the conceptual framework, the objective of the financial statements, well, we know that the objective is to is to provide financial information for users to make decisions. Okay, it needs to be consistent, it needs to be reliable, it needs to be accurate. Okay, those are some of the objectives. Okay, there's quite a few. We looked at some of the characteristics before. Okay, I'm just focusing on the primary objective. What do we want? We want good, reliable statements so people can make decisions. Do you remember what a going concern is?
To check if a company can continue working.
Correct. A company that will continue to operate.
Yeah.
Next time, well, not next time, it'll actually be a week or two from now, and we'll be looking at a liquidation. What does that word mean, liquidation?
Liquidation means when a company goes in because they are battling financially, so they have to liquidate their business.
Good. Okay, so see, now in this course, we're not only going to look at companies or, let's say, businesses that are going to continue to operate, we're also going to look at businesses that are going to liquidate, okay, or stop operating. Right, then we need to list some qualitative characteristics. There's a lot here, so maybe just give me two, Kirsty. What gives us, or what characteristics should good quality financial statements have?
Correct.
Okay, so they need to be accurate, reliable, good, relevant. What else?
Easy to read.
Okay, so easy to read, maybe understandable or comparable.
They all need to follow the same rules.
Okay, so that's understandability, consistency. Okay, yeah, so that's qualitative characteristics. Good. Okay, and then we've looked at a lot about the elements. Okay, so I'm comfortable you guys are happy with those 4: assets, liabilities, income, expenses. Let's look at this here. Okay, IFRS we've looked at. Okay, here, when assets are regarded as being current in nature, what does that mean?
Isn't that short-term assets?
Good. Okay, so timing is key, and timing is important because of disclosure. So if we don't know how to record something, okay, it's a problem because users are going to have the right information.
Yeah.
Okay, great. All right, so then the last bit that I want to look at here is this: some journals. General Journal of Lewis CC. Okay, so when looking at this transaction, right, I want you to practice what we've always done. Okay, so what do we do when we see a transaction? We read it and we do what?
Adjust it.
Highlight keywords that stand out.
Okay.
Okay, so let's first start with that. Okay, so please read it and highlight the words that stand out. Okay, have you guys highlighted words that stand out?
Yes.
Okay, what do we always have to look at as well? Besides those accounts, there's also something else that we need to be mindful of.
The date, if it's in the financial period.
Very good. Okay, that's important because we need to draw timelines. So we need start, we need end. Okay, and then we need to be able to identify, okay, what the accounts are. Okay, so what words did you identify?
I said 100 ordinary shares of 100 Rand each.
Good. Okay, so this should be standing out. Ordinary shares. So what is it?
Asset,
liability, income, expense, capital, drawings.
Asset.
Good. Why?
Because you own the shares, so it's a resource.
Exactly. Well done. Okay, so you own the shares, so it's an asset because it meets the definition of a resource. I'm happy with that. What else did you identify?
100 Rand each.
Good. So what did you use to buy those shares?
Money, bank, so capital.
Well done. See, that's important as well. So now you've got two sides of the transaction. You've got the shares and you've got the cash. Okay. Yeah. What else stood out in the question?
The transactions amounted to 500.
Correct. Good. And there you go. You've got everything. Everything else is just context. Okay. But what should stand out the most is what you spoke about now. Okay. Well done.
Yeah.
Right. So what do we debit and what do we credit?
You're going to debit the shares.
Why?
Because they're increasing.
What type of account?
It's an asset.
Good. And
then isn't the bank going to decrease?
Good. What type of account?
It's an asset as well.
Nice. Okay, and there you go. You've just recorded the first transaction. Now I need to get the monetary amount. Okay, obviously the rands and cents. So how many shares did I buy?
100. So it's going to be 100 times 100.
Which is?
Oh gosh, 10,000.
Yes. Okay. Right, and there you go. There's the first transaction. What date are we going to write here?
The 1st of March.
Correct. Beginning or end of the year?
Beginning.
Good. So 1st March 2014, start of the year. Okay. Did I have to pay transaction costs?
Transaction cost, yeah, 500.
Okay, so if I pay transaction costs, what am I going to record for those costs?
It's going to be expense.
Good. Transaction costs.
Yeah.
Or you can call it share expenses or purchase expenses. It all depends on how they refer to it in the question. Okay, and
it's going to be an expense, and then it's going to be bank.
Good. Okay, because you've paid it. Right, and the amount was 500. Yes.
Yeah.
Okay. Right. So let's go back and let's see now what else happened. What happened?
I'll check now. Okay. On the 28th of Feb, the end of the financial year, the shares were trading at 125 Rand each.
Good or bad?
It's good.
Why?
Because it's increased by 25 Rand per share.
Good. Okay, so what happened to the value of the investment?
Increase.
So how do I increase the investment?
By debiting it.
Perfect. There you go. Okay, remember this. Okay, this is the asset you own. It's now worth more. So what do I do to adjust the value of the asset on the 28th of Feb 2015?
You're going to increase the investment on the debit side.
Correct. And what will I credit?
Bank.
No. There's no cash here. Where's the cash here?
It's in the shares. So don't you credit shares?
No. Where's the cash here? Did I receive any cash?
No.
No. So what happened?
It just increased in the share value.
Yes. Okay, so have a look at your notes. What do I use to record the increase in the value of the shares? Gain
trading
on?
Sorry?
Gain on what?
Share value.
Fair value adjustment.
Okay.
Okay, because what did we say fair value represents?
The amount that you get.
The current value of the asset. Okay, so when we first bought the asset, it was 100 shares at 100 Rand each. Okay, gave us 10,000. Do you agree? Do you agree?
Yes. Yeah.
Okay, so what is this amount going to be?
It's going to be 12,500.
No, we can't record 12,500 because we're going to be looking at this account. Okay, so you're right by saying that 100 shares at 125 is 12,500. Do you agree?
Yes.
But what are you currently recording in your books?
The 2,500.
Yes, there we go, the difference. Okay, because now this, which occurred at the beginning of the year, and this, which happened at the end of the year, makes up that, which is the total at the end.
Yeah.
Does that make sense?
Yes, it does.
Okay, perfect. Okay, so let's check what they did here in terms of their solution. Okay, so there's the theory as well for those theory questions we had earlier. Where's the solution for that last? Okay, there's it there. Okay, yeah, there we go. So March, investment shares in Marble. Okay, so here they've grouped that one transaction as one journal entry. This is perfectly acceptable. If you show it separately like that, that's also fine. All right, because they've grouped these two together.
Yeah.
Okay, they've taken bank here and bank there, and they've grouped it as 10,500, and then they've shown those separately. Okay, Okay, I prefer doing it separately because you have debits and credits that belong to each other. Okay, so that debit goes with that debit goes with that credit. If you want to do it this way, that's also fine. It's totally up to you, as long as you don't make a mistake with the actual recording. Okay, but you need to get to an end result that has a debit, and a credit totaling 10,500. Okay.
Yeah.
Then we've got those two accounts. So we had that. Okay, that was the fair value adjustment. I see they've also included closing transfers. All right, so that's something that they didn't actually specifically mention in the question, but I'll add it here as well. So additional consideration for closing transfers. Okay, so remember, when I look at closing transfers, I'm going to be taking those amounts and I'm going to close them off to their profit and loss accounts. Okay, so if I look at this, is this an expense?
Is what an expense? Yes.
Okay, is this an expense?
No.
No, what is that?
It's the income.
Correct. Okay, I didn't put that in. Let's put that in. Income increase. Okay, so if I'm looking at closing transfers, a closing transfer would be taking those amounts and pulling it through to the T account. Okay, you've got the journal in your book, so I'm not going to do the journal again. I'm going to show you the T account. Okay, this account's going to be called profit and loss. Okay, and I'm recording those amounts in here. So obviously profit and loss would have a trading account reference, and that's the gross profit that would have come from the trading account. That's just a separate reference. Okay, there wasn't any sales and cost of sales in this question, so we can't record that here, but we can record these two. Okay, so remember, if you remember from 1502, keep it simple. Just remember what something is. If transactions cost is an expense, where will I put it in the profit and loss? Debit or credit side?
If it is expense, it's going to be on the debit.
Debit side, yeah. So the rules apply the same.
Yeah.
Even for this. So then you'll have transaction costs here. Okay, and you'll have 500 there. And the reason for that is you would have debited profit and loss. And then you would have credited the
transaction costs.
Costs. Okay, so then do you agree if I look at this account, okay, that account there, and that account there, this credit cancels with that debit. Okay, that's the closing transfers. Okay, so I'm just revising the closing transfers, but if you didn't understand that, don't worry about that. Let's try to keep it simple. Just remember, if it's an expense, expenses have a debit balance, so even in the profit and loss, the expense will be recorded on the debit side.
Yeah.
Okay. This is what type of account?
It's an income.
Income.
So it's credit side.
So where would that be recorded? Debit or credit?
Credit.
Credit side. So then you'll have gain on fair value adjustment. I'm just abbreviating so it fits. Okay, and I'll have 2,500 there. Right, quickly do the debit and credit for me here. I want this debit and credit.
So you're going to credit the gain on the fair value adjustment.
No.
Is it an increasing?
That's the increase. What's the closing transfer? Remember, these are the closing transfers. Give me the closing transfer to get this here. What did I do to profit and loss?
Increased it.
Debit or credit it?
You credit.
Okay, so credit profit and loss. Okay, does that make sense?
Yes.
There's it there, hey?
Yeah.
Okay, and then debit what?
Gain on fair value.
Gain on fair value adjustment. Okay,
Yeah.
because that's what I've had to close, because that was the closing entry. Okay, so this account that I've got here, I've closed that. I've closed the credit, and then this account, which is the transactions cost, I've closed that there.
Yeah.
Okay, so do you see how we've closed those accounts off?
Yeah.
Okay, you're debiting, crediting. Right, but again, those are the debits and the credits. If you wanted to keep it simple, just remember gain on fair value adjustment is an income, and income will be credited, even in the profit and loss accounts.
Yeah.
Okay, all right. You guys are right for this week?
Yes,
Yeah.
we are.
Okay, perfect. So remember, revision is key. So we will do more of this as we go through more examples. Okay, week 1 is just introduction, trying to get all the basics right again, just to make sure you're remembering all of it. From next week onwards, that's when we actually start the new content, which is the partnerships, and we're looking at disclosure already. Okay, so I'm going to be emailing you through some templates again, just so that it makes the workings a bit simpler to do. I'm going to be doing the workings obviously in Excel on the template as well, so you can follow with me. The video should be uploaded probably this weekend, so then if you want to watch the last 2 classes again, you'll have that access. I'll assign your specific Gmail accounts access to watch the videos, and we'll do that week by week as well. I do know how challenging this module is. Students have struggled with it before, but also students have gotten distinctions for it before as well. So if you put in the effort and you keep working consistently week by week, you should both be fine.
Yeah. Perfect.
Okay. All right, so if you can, maybe try to do some pre-reading for next week. Next week's not so bad because it's pretty much revision again, but with some new concepts in terms of partnerships. Okay, so we'll describe what they are, and we'll look at the actual accounts that we need to account for when it comes to the disclosure for that particular form of entity.